And we are live. Hello, everyone. Welcome to a new episode of Blockchain Talks. My name is Dimitri, your host of this live stream. Now, in today's episode, we are going to talk a little bit about the Ethereum merge, what it is, and actually going to debunk a few of the misconceptions and myths which exist concerning the merge. However, before I start, I want to do a little market analysis so you guys are up to speed with what's happening in the market. For that, I'm visiting, as you guys can see, CoinGecko. I'm going to take a small look on Bitcoin, as it still is the coin with the highest dominance and which decides which way the market will be going. Currently up with 1.4%, has a total value of $21,496. This is the 24-hour trading chart. As you can see, quite some volatility going on. 24 hours ago, we were trading at around slightly underneath 21k. Underneath 21,200k. Some volatility going on. We had a little sell-off. There was a little crash, which let people panic for a little while, but we found some support near the 21k level. Veered back up towards 21.4, remained there, was back a major sell-off, a little testing of support levels once again near 21k, and now we're zooming back up towards 21.5k. That for the 24-hour trading view. Things become more clear as we zoom out on weekly basis, and you can see we fell from 24k back towards, well, approximately around 21k, with 21k as a level of support being tested numerous times. As you can see here, August 20th, so 3 days ago, first time hitting support. Later on that day at 10 o'clock in the evening here in Belgium, once again tested support, veered back up, a little bit of a relief, went back down today towards 21k, went back up, went back down, and now we're heading back up. So there's some sideways trading going on. Currently, I'm dare to say we are testing support levels, probably before breaking back through towards higher trading levels, back towards the possible 24k. But everything remains to be seen. If you zoom out at the 2 weeks volume, you can see we tested a few times 25k range, which implies that's where our resistance currently is, meaning we need to break through here the 25k resistance level before we start to see higher trading levels. Everything becomes much more apparent when zooming out towards a monthly basis. And isn't the first time in the last month that we hit 21k levels. We just had some trading for some, we had some higher trading levels for the last couple of weeks, but as you can see here, end of July went back down towards 21k, found the support levels and veered straight back up. Seems to have made a support level at 23k, but was broken a few days ago, and we found no support at 21k. 90 days, as you can see, another pattern is forming. The crash you are seeing here is a result of Three Arrows Capital and Celsius Network bankruptcy, together with other exchanges, which became illiquid, so didn't have the necessary liquidity to remain functioning and had to be declared bankrupt. We then saw a little crash towards 17k before veering back up and testing new support levels. However, as you guys can see here, new support levels are being created here. First, we had at around heavy support 18 to 19k. Then we had a test of about 20k here. Same here. So we're veering back up. And if I were to draw lines on TradingView, you would see that there is an ascending line here, meaning we are slowly recovering from the crash that was spurred on by Three Arrows Capital and others. Zoom out at 180 days. We can see here in March, we're still trading at 45k. What you're seeing here is the Terra Luna collapse, the major sell-off. After that, after that, a month of sideways trading before the Three Arrows Capital, Celsius Network, Voyager, and others couldn't really cope anymore with the lack of liquidity and low value and had to be busted, really, which spurred on this little correction. And as you guys can see, retail and major investors are slowly eating up the dumped amounts of Bitcoin. And naturally, we see some recovery going on. I made a prediction in my free Telegram channel and on Twitter a few times already. We'll probably be seeing a sideways trading market, though I wouldn't be surprised. Somewhere near the end of this year, probably 2023, we will be hitting back levels at around 30 to 40K, so that we will have recovered towards these trading ranges. All depends on the amount of Bitcoin being bought up and naturally the market recovering. It was a healthy correction, which, well, most of us were waiting for. Before I continue, some people ask themselves, what spurred on this sudden crash and searching for support at 21K levels? Well, quite frankly, you will need to look at the dollar index trading chart, meaning, well, we are heading back up here, meaning, as you can see, this is 2022. The dollar is slowly increasing once again in purchasing power. This is factually good news for American citizens and the world as a whole, a reason the US dollar still is the world currency. As you guys could see here, 2020, 2021, we saw some major inflation going on, major loss of purchasing power, which are now slowly getting back up. Naturally, this translates into Bitcoin being devalued by reason, well, the lower the dollar index stands, the more people will flee towards digital assets to protect their wealth. Now, if this one's increasing, it implies more people will start selling off their Bitcoin or digital assets in exchange for money because it has regained purchasing power. It's a really simple thing to follow. This as a little aside here. Now, let's start talking about the merge. Now, what is the Ethereum merge? I'm going to switch places here. And this is actually, in a nutshell, on the main Ethereum website. I'm going to base myself off here so you guys can see I'm not pulling your legs. What it is all about and what it does. The merge. Soon, the current Ethereum mainnet will merge with the Beacon Chain proof of stake system. This will mark the end of proof of work for Ethereum and the full transition to proof of stake. This is what the merge is. It is a switch from consensus protocol. Currently, Ethereum is running on a proof of work consensus protocol, just like Bitcoin. However, in December 2020, they finally arrived and launched their Beacon Chain. This as a first step in order to transition towards proof of stake. Now, what is the Beacon Chain? You guys saw it earlier here. It introduces proof of stake to the Ethereum ecosystem. It will coordinate the network serving as the consensus layer. It is an essential precursor to upcoming scaling upgrades such as sharding. Now, perhaps not so much saying, but you need to visualize it as such. I'm going to stop sharing my screen. I'm going to do it this way so you guys can pay attention to what I'm saying. I'm going to show here. So imagine this, my arm, is the blockchain. This is your mainnet. This is proof of work. However, in order to transition towards a proof of stake, you will need to add an additional layer. That's my second arm. And both need to interact. The second layer, so my right arm here, will need to save the same kind of movements and transactions from the mainnet. As such, both currently coexist in this way. The beacon chain will, when the merge finally occurs, take over all responsibilities of the main net by reason that it has all data saved. The beacon chain is nothing more than a layer 2 solution which will eventually become mainnet itself. It will eventually become layer 1. The previous layer, the mainnet itself, the L1 currently running on proof of work, will become obsolete. It will be stopped in a certain sense. In how to put it in an easy way, it will be stopped in the sense that Ethereum no longer will be mineable through proof of work. Now, a fork can occur whereby the main chain can still exist, but it will be no longer considered as the layer 1 or make part of the original, between brackets, Ethereum chain. It will be proof of stake. That's basically what the beacon chain does. It is a layer 2 solution which currently coexists with the proof of work mainnet, but at a specific date, the proof of work mainnet or proof of work blockchain will be halted, and the beacon chain will take over its responsibilities, data, and transaction history. And as you guys can see, and as I've told, the beacon chain shipped on December 1st, 2020. To learn more, yada yada yada. The beacon chain already works on proof of stake. Starting from December 1st, 2020, you could start staking your Ethereum to support the beacon chain. It's already Ethereum running on proof of stake network, but it isn't considered as of date, not yet as mainnet. Both coexist. And you guys can see what does the beacon chain do. You guys can read. Beacon chain is a ledger of accounts that conducts and coordinates the network of stakers. It isn't quite like the Ethereum mainnet of today. It does not process transactions or handle smart contract interactions. It is a new consensus engine or consensus layer that will soon take the place of proof of work mining, bring many significant improvements with it. Beacon chain's role will change over time. It is a foundational component for the secure, environmentally friendly, and scalable Ethereum we're working towards. And here we go, merge at the end of mining. So that's basically rehashing from what I've said in more technical terms. And that's what the merge is about. The merge is about transitioning from a proof of work consensus protocol towards a proof of stake consensus protocol. This is being achieved by making use of a layer 2 solution, which currently is saving all transactions from mainnet onto its very own blockchain, with the intent of becoming the mainnet itself, main Ethereum. Currently shipping third quarter or fourth quarter of 2022. Most significant upgrade. We have been waiting for it for quite some time. And this is practically what I've mentioned, but more and better visualized. Currently, we are proof of work. We are still here. And this is the beacon chain which occurred. And from this point here, the merge proof of work mining will stop and everything becomes proof of stake. In a later date, will sharding become available. That is a special update which has to do with scalability of the network. That's all I can share currently about the proof of stake and what the merge is about. Now you guys are up to speed. And I believe there were a few questions being made that debunk what it does. And now I'm searching here after the merge. Here we go. These are the most important questions answered by the Ethereum Foundation itself. Why am I mentioning this? Well, sorry. I just noticed I wasn't sharing my screen here. That's a little F up from my part. Share screen. There we go. Sorry, guys. Little F up. So what I wanted to show you guys was this, the beacon chain. So once again, explanation. It has been shipped on December 1st, 2020. You guys can see it here. I'm streaming live from the Ethereum official website itself. What does it do? You can read it here in its entirety. There we go. Charting has to do with the scalability of the network, and as you guys can see, it's shipping in 2023. And now I wanted to talk and going to show you guys here some misconceptions about the merge. First misconception: running a node requires staking 32 Ethereum. False. Anyone is free to sync their own self-verified copy of Ethereum. It has to run a node. No Ethereum is required, not before the merge, not after the merge, not ever. Now, to understand this question, you need to know what a node is. And a node is nothing more than a user having a core wallet running on his computer, which saves a copy of the blockchain. As soon as you have a core wallet and you have a copy of the blockchain, you are effectively running a node. What does running a node mean? Well, running a node implies that you have a backup copy of the blockchain on your computer. You do not need to stake in order to run it. Is staking required? Well, staking is required, and that's the misconception here about the question, is when you want to become a validator or a master node. What do these two do? Well, they are the replacement for the proof of work miners. A master node and a validator need to stake or risk a certain amount of money in order to get granted some rights to save and verify transactions. And that's why this misconception is running a node requires staking 32 Ethereum. No, if you want to become a validator on the proof of stake network, you will need to stake said 32 Ethereum. Otherwise, if you have a copy of the blockchain, you are merely running a node which is free of costs. And this is explained in detail here. If you want to read it, I would say pause the screen. I'm keeping it available here for 2 seconds so you guys can save and read it up. There we go. Next up, misconception: the merge will reduce gas fees. This is a very big one. I have encountered this misconception and myth multiple times, and here it's straight from the horse's mouth. The merge will not reduce gas fees. The merge is a change of consensus mechanism, not an expansion of network capacity, and will not result in lower gas fees. So the high gas fees we've seen in the past with Ethereum during a bull run will still reoccur even if we transitioned towards a proof of stake. And now people will say, yeah, but if I'm looking at, can even show you guys here. They are relatively low, as you guys see here. OpenSea sale at about $1 currently. This is going to increase. This is being live updated. Currently, it's low. However, when compared to other projects, it's actually on the higher side. In the past, when during a bull run, there was a lot of so-called network congestion, meaning plenty of activity on the network. And then we saw much higher fees. These are factual gas fees taken, when was it? August last year, during a little dip in the bull run. And we see here average 30 Gwei, 39 Gwei, swaps at average ranging between $6 up to almost $20. That's for a simple swap. And I've been tracking it more intensively because this was made 12th of August, 24th, almost exactly 1 year ago. We had swaps like these, ranging from 12 to 40, almost a doubling. A few days later, 3 days later, we were greeted with swap fees like these. $13 up to above 50. I believe there was another one. There we go. 26, almost 30, upwards towards $82 in gas fees. Meaning that the myth, well, not a myth, but the problem of high gas fees isn't going to be fixed. Straight from the horse's mouth, I'm not bullshitting you guys here. Misconception: transactions will be noticeably faster after the merge. No. Though some slight changes exist, transaction speed will mostly remain the same on layer 1. By reason, there's only a transitioning towards another consensus protocol. On block size and on the creation of blocks and the capacity offset blocks, nothing is being changed. It's only the consensus protocol. You will no longer need to work in order to mine Ethereum. You will only need to risk a certain amount and you get validating rights. Anything else on the blockchain, its transaction speed, its block size, etc., remains unchanged. And this, the merge will reduce gas fees being debunked, is actually a direct result of, well, no change on the blockchain happening except for how consensus is being established. This is also a dirty one. Misconception: you can withdraw staked Ethereum once the merge occurs. Now, many people, like myself, have Ethereum in their own wallets and have a part staked on a variety of exchanges. It is being called Ethereum 2. It implies that it's Ethereum being staked in order to establish a validator node or a master node. This helps supporting the beacon chain, which will eventually become mainnet. However, there was the promise that as soon as there was a transition towards mainnet, that said staked Ethereum would become available. However, said promise has been broken, and they said, look, we're not going to enable the people to withdraw their staked Ethereum once we have launched. We are going to do that with a next upgrade, which they call, as mentioned here, Shanghai upgrade, which will enable the staking withdrawals. So currently, all who started staking in on December 1st, 2020 to support the beacon chain will only be able to withdraw their Ethereum once again later on when the Shanghai upgrade has taken place. And when is it? Well, it's actually being mentioned here. Staked Ethereum staking rewards to date and newly issued Ethereum immediately after the merge will be still locked on the beacon chain without the ability to withdraw. So all gains you've made on by staking on the beacon chain, you won't be able to withdraw. Withdrawals are planned for the Shanghai upgrade, next major upgrade following the merge. This means that newly issued Ethereum through accumulating on the beacon chain will remain locked and illiquid for at least 6 to 12 months following the merge. Knowing Ethereum, it implies your Ethereum is still locked for an additional year. Now, I can understand why they did this. By reason, a lot of people started staking on December 2020 with the hopes to make some nice gains, to make some nice profit. However, we are currently in a bear market. A lot of people are selling off their digital assets, their crypto holdings. The second the merge occurs will, and those are official numbers I've seen and quoted a few times on social media, currently 10% of Ethereum is being staked in support of the beacon chain. Should the merge occur, is there a very high chance that 10% of their total market cap will suddenly be lost by reason that the staked Ethereum will have become available and people just selling off massively. In order to negate it, they are trying to spread it. And they say, look, we're going to keep it locked up for an additional 6 to 12 months in order for the network to settle, to get in, and naturally to protect the current market cap they have. Naturally, I have two thoughts about it. I consider it a little bit fraudulent. However, at the same time, I can somewhat explain. I wanted to say no. I can somewhat agree why it is being done. Second misconception: validators will not receive any liquid Ethereum rewards till the Shanghai upgrade when withdrawals are enabled. False. Fee tips MEV will be credited to a mainnet account controlled by the validator, available immediately. Meaning their withdrawals are enabled. Naturally, Ethereum needs to be continuously mined, and it would be insane to keep all Ethereum locked on the beacon chain even after the merge. So there needs to be some kind of mechanism which allows for some additional Ethereum to hit the markets. Otherwise, we have, well, some major congestion going on, and the heavy risk there will be a major sell-off. So they're now spreading the risk. That's basically what's being said here. If naturally you are running a validator node, which implies you must have had staked 32 Ethereum. Simple as that. Misconception: when withdrawals are enabled, stakers will all exit at once. False. Validator exits are rate limited for security reasons. Naturally, in order to support the network, they implemented, well, the aforementioned limit with the Shanghai upgrade, so that not everyone and everything can suddenly do a massive sell-off of their staked Ethereum as it become majorly available. Now saying, look, if you are a validator, you can receive new Ethereum for the work you're doing, naturally. But why would you? By reason there is still a great incentive. There's more Ethereum hitting your wallets still. So this is being done by reason a lot of exchanges, platforms, allowed people to stake their Ethereum by reason a lot of people like myself didn't have enough Ethereum to run a validator node. They only have 4 to 5 Ethereum in their wallets, or less, or slightly more. In any case, less than the needed 32 Ethereum in order to become a validator. So what did they do? They moved it towards an exchange, put it there, and allowed, and I know Kraken does this, and allowed and said to Kraken or their own exchange, look, this is my Ethereum. I want to help out the Ethereum network by staking it on the beacon chain. And instead of them doing it themselves, it will be the platforms doing it in name of its users. It allows for a service whereby said exchange runs multiple validator nodes through the staked Ethereum that its users have been giving to them. There's an entire discussion to be had about it where it concerns security and not your keys, not your coins. However, this also implies that there's a certain buffer going on. Even if I were to withdraw my coins, the validator, the exchange that the exchanges run, will keep on running. By reason there will be other people compensating for said loss. So this implies there will not be an all-out go-away run, an all-out exit. So there's a little incentive here. Staking APR is expected to triple after the merge. More up-to-date estimations predict closer to a 50% increase in APR post-merge, not a 200% increase. This has to do with presumed gains you will be making from the staked Ethereum and what its value will do. We shall see what occurs. I do not have a crystal ball wherein I can predict the future. However, they have implemented a variety of mechanisms to make sure that not everyone at the same time exists or stops supporting the beacon chain when the merge occurs. They made sure there's a decent basis and people to continue onboarding as soon as the merge occurred and after it. Misconception: the merge will result in the downtime of the chain. False: the merge upgrade is designed to transition to proof of stake with zero downtime. I wouldn't be entirely sure of that. There might be some congestion issues going on. Do not forget, the Ethereum chain every second is saving and having multiple transactions being saved on the blockchain. As soon as the merge occurs, there might be some congestion going on. And while there might not be a downtime, expect some trouble. Expect, some delays or even a little, I'm not going to say downtime, but expect some problems to occur. It is, as being mentioned here, immense amount of work has been put into making transition to proof of stake that does not disrupt the network or its users. The merge is like changing an engine on a rocket ship mid-flight and is designed to be performed without needing to pause anything during the switch. Merge will be triggered by terminal total difficulty, which is a cumulative measure of the total mining power that has gone into building a chain. Time comes and this criterion is met, blocks will go from being built using proof of work in one block to being built proof of stake in the next. Ethereum does not have a downtime. This isn't as much as fact, but moreover a possible prediction they're going to do. We shall see what occurs. Now, what happened to Ethereum 2? In reality, Ethereum is Ethereum. And in here they explain, look, there's Ethereum being made on the beacon chain currently, or the one that will become mainnet. But that isn't really the Ethereum being made available today or available on the exchanges, etc., or in your wallets. As soon as the merge occurs, will that Ethereum, as being proven here, be slowly introduced to the market towards the validators, etc., etc. There is no Ethereum 2. There's only Ethereum in their minds, and is now the execution layer or on mainnet. Ethereum 2 is actually the Ethereum already mined on the beacon chain for the last 2 years. And with that, I'm going to stop sharing my screen, and I'm going to finalize here this live stream. I hope a few things have been cleared up. A few misconceptions have been debunked. And with that, I'm going to say thank you guys for watching. I hope to see you next time. Bye.